A country that has been frozen out of global oil markets just shipped 40 million barrels and is charging buyers a 20% markup over market price to do it. Think about what that actually means. If Iran can command a premium while emerging from sanctions, it tells you something specific about who is buying, how desperate they are, and what that implies for every energy position you are currently holding. The real story is not the export number. It is what the premium reveals about the structure of global oil demand right now. Let us start with the number that should stop you cold. Iran says it is selling oil at a 20% premium. Not a discount. A premium. Every instinct from Econ 101 tells you that a supplier returning from years of isolation should be cutting prices to win back market share. That is the standard playbook. Undercut the incumbents, rebuild volume, then normalize pricing over time. Iran is doing the opposite, and that inversion is the most important data point in this story. There are two credible explanations, and they are not mutually exclusive. The first is contractual urgency. Buyers who had locked in supply agreements contingent on the blockade ending are now executing those contracts at pre-negotiated terms that reflected geopolitical risk premiums baked in months or years ago. The price was always going to look elevated relative to spot because the deal was structured under a different risk environment. The second explanation is more structurally significant. The buyers need this oil badly enough that they will pay above spot to secure it now. That implies tightness somewhere in the global supply chain that the headline crude benchmarks are not fully pricing in as of July 2026. When a newly unlocked supplier can hold the line on price, it means the market was genuinely undersupplied relative to demand. Or, at minimum, certain grades and delivery routes were. For investors watching energy markets, the actionable insight here is this. The premium is a leading indicator, not a lagging one. It suggests that the re-entry of Iranian barrels has not yet materially relieved supply pressure. Watch whether that premium compresses over the next 30 to 60 days. Rapid compression would indicate the market absorbed the supply. Sustained premium would confirm structural tightness. That distinction matters enormously for positioning in energy equities and commodity futures. This is analysis, not financial advice, but it is the kind of signal worth tracking systematically. Now let us zoom out and place the Iran story inside a broader macro frame because it does not exist in isolation. One of the other major headlines moving markets right now is that the U.S. auto industry is facing heightened uncertainty without an extension of the USMCA trade deal. On the surface, that sounds like a manufacturing story. But pull on that thread, and you find an energy story underneath it. Here's why. The USMCA framework governs trade relationships between the U.S., Canada, and Mexico, three of the largest oil and gas producers and consumers in the Western Hemisphere. Canada is the single largest source of U.S. crude oil imports. Mexico's state energy sector is deeply intertwined with U.S. refining capacity along the Gulf Coast. When the trade architecture governing those relationships enters a period of ambiguity, energy supply chains absorb that uncertainty as risk. The auto industry angle matters because vehicle manufacturing is one of the largest industrial consumers of energy in North America. If auto production faces disruption from trade deal uncertainty, that affects both industrial fuel demand and the broader economic signal that energy markets use to calibrate forward expectations. Reduced industrial output is a demand-side drag on crude. But here's the counterintuitive piece. A North American trade disruption that simultaneously tightens the political appetite for energy imports creates a scenario where domestic production premiums widen. U.S. producers could see pricing advantages if the USMCA vacuum is interpreted by markets as a supply chain regionalization signal. Layering the Iran export story on top of this is analytically important. You now have a major exogenous supply increase from the Middle East, entering a market where North American trade policy is uncertain. These two forces create a genuine tension in crude pricing models for the second half of 2026. Neither story alone tells you where oil goes. Together, they define the range of outcomes. Understanding that range, not predicting a single number, is how serious investors manage positioning under genuine uncertainty. The Iran situation is genuinely novel in its 2026 context. But sanction unwinds as a category are not new. We can look at historical precedent, clearly framed as pattern recognition for educational purposes, not as a predictive model, and extract a few durable observations. When a major producer re-enters global markets after a prolonged isolation period, the immediate market reaction is frequently counterintuitive. Prices do not always fall sharply on the announcement, because the market has already been discounting the probability of re-entry for months. The real price discovery happens in the 60 to 90 days after the first significant cargo movements, when the market can actually measure the pace of volume normalization. In the case of Iran, 40 million barrels sounds enormous in a single headline. But, to put that in context, global oil consumption runs in the range of roughly 100 million barrels per day. 40 million barrels total is less than half a day of global demand. The question is not whether those barrels move the headline price immediately. They probably do not move it dramatically in isolation. The question is what the ramp rate looks like. If Iran can scale from 40 million barrels in this initial tranche to sustain monthly exports of comparable or greater volume, that is where supply-side repricing becomes material. For energy-linked equities specifically, and again, this is pattern analysis, not a trade recommendation, historically the most volatile period for oil-sensitive stocks after a sanction unwind is not day one. It is weeks 3 through 8 when the gap between market narrative and actual supply data starts to resolve. Investors who position based on the headline often get the direction right, but the timing wrong, which in options and leveraged instruments is functionally the same as being wrong. The smarter framework is to track the actual cargo data. Watch the premium compression rate we discussed in Section 1. And let the supply ramp rate tell you whether the initial headline was a structural shift or a one-time release. The data exists. The discipline to wait for it is rarer than the data itself. We opened with a question. What does it mean when a sanctioned nation commands a premium? The answer is that the premium is your real-time signal. It tells you whether those 40 million barrels actually relieve pressure or simply add complexity to an already uncertain market. Watch that number compress or hold over the next 60 days. That is your read on where this goes. Next video. What AI-driven commodity trading systems are actually doing with this data right now? Subscribe so you do not miss it.